Feels like a long time ago, right? But remember, the market got off to the worst start in history ever. You remember those headlines that cast these dark shadows over investors. The Dow gave up 2,000 points, and then all of a sudden, it began to stage a turnaround for the ages. Now, my next guest, well, he called it even during the darkest moments. Joining me now, Peter Morici. Peter, you were always calm, cool, collected. You crunched the numbers. You said things would get better. They did, but where do we go from here?
Well, I think there's a lot to be optimistic about it. The price-earnings ratio does not indicate that the market's overpriced at all, if you look back over the last 25 years. And I think the second half of this year, we're going to gradually see an improvement in profits, and we'll do pretty well. Now, we're going to have a rocky time over the next month as we get our first quarter reporting, and earnings aren't as good as a year ago. But the economy is getting better, and I think profits will get better with it, and American companies are going to do well.
You know, here's the thing, Peter. Earlier in the week, the Atlanta Fed saw first quarter GDP. Now they see it at 0.06%. You know, it's just 0.6%. At one point, we're at 2%. Every quarter, we get these lackluster quarterly numbers, and somebody says, don't worry about it. The next one will be great. And, I mean, is there ever going to be a correlation between this flaccid recovery and the stock market? How can they coexist?
Well, I think that they can coexist. However, I wouldn't put too much stock in the first quarter number. We've been having one bad first quarter number after another over the last several years simply because of the way the data is constructed. The seasonality in the economy has changed, and the adjustment factors that BEA uses have not accommodated that. I've been pretty consistent in my forecasts. I think that the economy can grow at about 2.5% a year. Now, that's hardly Ronald Reagan growth. But at that pace, businesses can make money and even more money, and that's going to happen.
Peter, for me, one of the things I like, because I did a lot of blue chips this year. We're in IBM, we're in Caterpillar. My subscribers are in Chevron. The weak dollar. Do you see the weak dollar getting any weaker? Because I think that's going to be one of the keys for these multinationals.
Well, the dollar's not weak. It's just come off some highs.
The weakening dollar. The weakening
dollar. I think that's going to continue. If you know, critics have pointed out that, well, you know, the central bank in Europe and in Japan, they're going to have more stimulus, so that's going to make the dollar stronger. Look at what's happened this quarter as they've tried to push down their currency. It doesn't work anymore. They've run out of bullets. My feeling is the dollar is still overvalued and could weaken somewhat further. The Fed can get away with gradually increasing interest rates. 0.5 point is hardly anything to worry about. You'll still be below 1%. So I don't think the dollar is going to be an additional factor weighing on American business.
Well, no, I like the idea that it will weaken also. I've kind of built an investment strategy around that. Before I let you go, what's the one thing you are concerned about? What could be the wild card here?
Well, business investment hasn't picked up as much as we'd like simply because businesses are learning how to use capital so much more efficiently. And there's so much investing going on that doesn't count. Look at GM's recent acquisition of Cruise Automation for $1 billion. They hardly spent anything generating that software compared to $1 billion. American business doesn't need to spend a lot on a lot of machinery these days. They need to think about things more. That's happening, so that's a weak spot.
Right. All right. Peter Morici, you've been spot on. You helped a lot of people through some dark times. Thanks a lot, buddy.